Hello traders, in today's video I'm going to be talking about locked-in range analysis by Tom Lexkey, and this is something that I would say is likely the modern day Wyckoff and probably even better than Wyckoff. Let's go in. Hello traders and welcome to LRA by Tom Lexkey. I'm going to be covering all the analysis that was covered in a free ebook. This is going to be linked in the description below for this whole 66-page doc. That I have found to be amazing. Really, really amazing work that Tom Lexkey has done. I don't know how this hasn't gotten more coverage, but it's just beyond me. I wish I'd written this, but I didn't. But I do have the pleasure of introducing the work that Tom has done on Forex trading, which I'm going to apply to cryptocurrency trading. Okay. This is a long document. I mean, it's 66 pages of a lot of interesting information. But for me, I read it 9 times. I kid you not. I read the relevant sections, which is about, I think, like 40 pages of it, 9 times over and over again and applied it to the markets. And found that all the trades that I took with this analysis worked. Because what this analysis is, guys, to summarize it, it categorizes the market into just 2 people: market makers, retail traders. Market makers are taking the opposite trade of the retail traders. Now, the market makers' goal is they're going to hold long positions, they're going to hold short positions, they're providing liquidity. But they have positions open, right? And what they want to do is buy as low as possible and sell as high as possible. How do they do that? Well, they need to find a way to get retail traders to buy as high as possible to fill their sell orders and to sell as low as possible to fill their buy orders so that they can trade at the best possible prices. And this video today is going to show how they do that, and this video today is going to show how to take advantage of this. So there are 3 main lessons from LRA. There are dozens of other things you can learn from this. There's just 3 things that I found to be the most interesting. 1, price is fueled by trap traders. Price tends to just keep going up and up, or price tends to just keep going down and down. And what tends to happen when price tends to do that is that there's a trapped trader side. So typically there's a long period of consolidation in crypto or in Bitcoin, right? Let's say lots of shorts entering, then price begins to go up. A lot of those shorts believe that the price is going to come right back down. And that's what keeps them trapped, because they just keep thinking the price will just come down and that they'll just exit at break even, right? But then the price just keeps going higher and higher and higher until it gets to a point where the loss is too large. They get stopped out of their position, or they get liquidated. If any of those 3 things happen, right after it does, typically price just comes right back down. This is the kind of sadistic nature that price has to trap traders. Okay? Now, what do I mean by trap traders? Well, I'm going to read point 2, and then I'm going to show point 2 on a price chart. The larger that the open interest in a price range is, the more trap traders there are, and subsequently, the stronger that the range will likely be. I want you to look at Bitcoin and open interest. Don't look at this yet. Just focus on open interest in Bitcoin, okay? Specifically on Binance Futures here, I'm going to show you guys a certain market range. Look what happened from here to here. What happened? Well, open interest went from 40,000 Bitcoin to 42,000 Bitcoin. Now that by itself might not seem that interesting to you, or if it does, then you're a step ahead. But what that means is that there's 2,000 Bitcoin worth of shorts and longs, right? What that also means is that a lot of those shorts that were trapped are going to be trapped for quite some time, or until they get liquidated or stopped out. Now what ended up happening is right after they're trapped, price goes up, and probably a lot of those shorts are like, oh, I'll just hold on my position, and price is coming right back down. Price lets out a few of them to get a break even, and then it just skyrockets. I took a trade on this, and I went long with 60,000 contracts. And I did this because I saw there were so many trap shorts here. I knew for a fact that these guys weren't going to survive. They're lambs for the slaughter, you know, chips in the wood chipper. They were going to get obliterated. And they did. But not completely yet, because open interest is still pretty high, which means that it's likely that a lot of these shorts are still trapped, which also means that if price is to come down again, it's probably going to get bought right back up because of how many traders are trapped here, right? But there's a scenario where price can actually come down. And before all the shorts that were trapped here say, oh, what is it? Well, it's not good for you if you're one of the trapped shorts here. A common pattern that price can do that you've probably seen 20 million times is a skyrocketing Bitcoin price just wicks really, really high. And then it comes right back down. Why? It does that because it's killing all of the shorts at terrible prices for the shorts, liquidating them, stopping them out, so that the market maker can take those positions and move short. And when the market maker moves short at very good prices, then the price just dumps. And as the price dumps, these shorts that were here start saying, oh my God, if I had just held on to my position, added more margin, not been liquidated, not been stopped out, I could have made, a lot of money. Yeah, they could have, but these kinds of patterns ensure that you really probably won't if you get trapped here. But we can take advantage of people like this. And the way that we did, and the way that I was actually able to take advantage of this, is I noticed that every single time that price is going to even try to come down to this range, I knew that it was going to get bought right back up. We weren't going to just let these shorts escape that easily, and we didn't. I mean, even when we had a price low like here, where I was kind of like, is this going to happen? Are we going to let them out of the? Is it going to be a jailbreak? They didn't get let out. You can see the price just had an inability to move any lower, and then price went, 0.8% higher. So that's a really cool illustration of the second point. And the third point is a really cool one too. We want to place our stop loss at a point right beyond a trap trader area. There's a really funny reason why we want to do this actually. Two. The first one is that if we know that a lot of traders are trapped here, when you go long here, so let's say, we know a lot of people are trapped right there in shorts. Great. We go long here on the retest because we know that price isn't going to let all these guys get out. It's going to skyrocket and try to kill as many as possible before going back down. Or it's going to allow some of them to get out at break even. And if it does allow some of them to get out at break even, it'll just keep dropping and they'll wish they had stayed in their positions in the first place. But that's beside the point. What I'm showing here from my third point of placing your stop loss right behind that area, we want to place our stop loss just around here because we know just how many traders are trapped here. And if there are a lot of trapped shorts here, what that means is they're going to buy it right back up. If price is to come right back down here, it could just be bought right back up because so many of them are trapped, and the temptation just to take break even after a long prolonged loss is very high. Especially the longer that loss continues, the more pain it inflicts, and the more they want to just get out and make $10 or $15 or 35 cents on that trade, or just like lose $2 or something like that. Basically break even either way. And because of that, a stop loss here is typically pretty healthy. Now, there's another second reason. Now, listen to this. There's a second reason why placing a stop loss around here is really smart. It's because it's where a lot of the trapped shorts are placing their take profit. And we know for a fact that price does its absolute best to ensure that retail traders do not have their take profit hit. If a lot of trapped shorts are putting their take profits around here, because that would give them marginal profit, because a lot of them probably shorted around there, put their take profit right here, I know that price is going to gravitate away from that take profit and also gravitate away from my stop loss that I place at their take profit. I know this from the ebook that talked about it in here in one of these pages. Let me see if I can find it for you guys because, oh my God, it was such a good thing. Okay. This whole section, you should probably just pause the video and just read this here, or just download the ebook and then read it and, do it that way. Yeah, here it is. I remember here it is from this 7th or 8th time I read this probably. The likely levels of execution of market participants take profit. You'll understand what this means. Ignore it for now. Is where you want to place your stop loss. It's saying place your stop loss at the likely levels of a lot of these trapped traders take profits, which in this case would be here, and which in this case never got hit. This is just some of the analysis from Tom Lexkey. There is so much more, and I'm even thinking about doing a playlist devoted to this because there's so much to cover. This is just like the beginning of this analysis. There's so much more to it. Of trapped traders, of their stop loss, of their take profits, of retests of trapped areas, and how a large increase in open interest can make it very, very likely that will be turned into support resistance, and that a complete drop in open interest makes that place typically get cut open like butter, meaning that it won't act as, what's it called? It won't act as very strong support or resistance. Ooh, that's a beautiful example. What I mean by that, guys, is I want you to focus on this range right here. This is another LRA, locked in range analysis that we have here. Two really interesting things happen. I'm going to make it as simple as possible for everyone here to understand, okay? Focus on open interest and focus on price. Open interest did not rise. It was flat. There's nothing happening here, guys. Maybe rise a little bit, but just nothing really. Not many traders are taking positions. Now, if there were any longs who had taken positions, they all get killed by this kind of volatility. You can see open interest just tanks completely and goes back to where it was like around here. So the longs are killed. And the shorts may have taken a little bit of profit, but knowing most retail shorts, they probably didn't even suck out this whole move. They probably only took profit like around here, or maybe here if they got, lucky. But I doubt that many of them were good enough to take profit, something like this. Okay. Now, what ended up happening is price had no difficulty crossing through this area. Why? Well, because there's no one trapped here. And if there's no one trapped here, price just, okay, I'll just cut right through you. It just cuts right through it. Because there's no one really here that's that interesting. There's open interest is two things. First of all, open interest is flat, showing me that not many traders had even open positions. Some had, but not many. Two, we know that open interest tanked when price dropped, meaning that a lot of those longs probably already exited. So the market maker is probably already long. Market makers are probably long, and retail traders are primarily short. How do I know that? Well, if you look here at the longs and shorts, we can see that that's falling, indicating that a lot of accounts are going short. And that's what just fuels this trend higher and higher. And that's also another reason why I went long here. Okay? Yeah, so like I said, there is a lot more to this analysis, and I really don't think that I did this enough justice of just how good of a resource that this is. I will be honest, this is my 15th take that I've taken. I'm trying to do like a one-shot, no editing, just full take. This is the 15th time I've filmed because covering this is just so difficult. Not because this is just super complex, but I just want to make it as good as I possibly can to do it justice, right? But keep an eye out for trap traders. Keep an eye out on open interest. Always think of where these traders are putting their stop losses and take profit. Always think of where the trap traders are. And as Tom Lexkey says, if you're not thinking of this, you are gambling or just relying on luck. If you're relying on RSI and technical indicators like that I used to cover, don't do that. I mean, that's not financial advice. That's just something that I don't even use anymore because it's stuff like that 90% of the crowd uses. 90% of the crowd is going to lose money. If you think that you have some amazing technical indicator because it's some custom indicator that you bought or something like that, it's probably not going to even work that well time and time again. The things that do work well are exploiting other traders. And exploiting other traders using market making techniques, identifying what the forces in the market are, identifying how you can align yourself with the strong forces, fight against the weak forces, and then take losses if you need to take a loss. And that's it. That, for the past few days, has worked very well for me. And at this point, I think that this does apply as my main analysis. I don't think there's any other analysis, speculative-wise, that I would say is better than this. So I've only gotten 6 hours of sleep the last few days because of my obsession with this. But now, after this video, I will go back to sleep and rest easy as these shorts are trapped. And do we have any trap longs up here? And maybe some longs are trapped up here, and definitely some trap longs were here. We had trap longs here. That's why price kind of went only a little bit higher, then went back down, because these trap longs took profit, and we didn't want too many of these trap longs to be profitable, because that would be inefficient of the market. That's why that happened. All right, guys, if you enjoyed this video, let me know. Let me know if you want the playlist, and yeah, that's going to be it for this video. Happy trading.